In this week's video, we'll review the latest fundamental, technical, and political data to help us make a logical and rational assessment of impeachment's impact on the stock market. We all know that when it comes to making prudent decisions in the financial markets, engaging in political debates increases the odds of ego-related and emotional missteps. Therefore, we'll all be better off relative to the stock market if we can push our personal opinions aside and leave emotions out of this analysis. We know with 100% certainty, in order for President Trump to be removed from office, at least 20 Republicans in the Senate will have to vote in favor of impeachment. Professional third party estimating the odds of impeachment at 10% based on the left side of your screen. We have to keep in mind that if 18 Republicans in the Senate vote to impeach, the president stays in office. You need 20 votes. According to the Gallup organization, President Trump's approval rating with Republican voters is over 90%. It might be helpful if we examine the question from this perspective. Think about this. What are the odds that 20 Democratic senators will cast their personal presidential ballot for Donald Trump in November of 2020? Think you can make an argument that those odds are about the same as getting 20 Republican senators to vote for impeachment before the 2020 election. Based on the approval ratings on the right side of your screen, it would be very, very difficult for a Republican to vote to remove President Trump from office and then expect to get reelected in the next election cycle. The concept of self-preservation applies to investing, and the concept of self-preservation applies to this topic as well. How about fundamental data? We know that it's going to be very, very difficult to go into a horrible and long-lasting recession if most people have a steady job. Have we seen anything in the last 4 weeks that tells us we might see a big spike in the unemployment rate when the next monthly jobs report is released in the coming days and weeks? The answer is no. Once again, we did not see a big spike in weekly jobless claims over the past 5 days, and the 4-week moving average of unemployment claims has actually dropped over the past month. Let's take a look at market breadth. Why is market breadth important? This red line here is NYSE common stock only. It's the advanced decline line. When the advanced decline line starts to plummet, as it did in late 2007 and in early 2008, it basically tells us that the institutions are running for the exits. This line peaked 4 months before the S&P 500 peaked. Similar situation here. Calendar year 2015. The stock market plunges in August here. 5 months before this plunge in the stock market, the institutions have already started moving toward the exit. How does the exact same chart look today after all of the new items crossing the wire this week? Better, worse, or about the same? And more importantly, does the exact same chart tell us that the institutions are running for the exits as they did here and as they did here? The answer is absolutely positively no. Instead of a bearish divergence that we have in place here, instead of a bearish divergence that we have in place here, we have a bullish divergence. The NYSE common stock only advanced decline line on a monthly basis is set to print a new all-time high. This AD line has already made a new high well before the stock market has printed a new high. Look at the slope of this line here where my cursor is. and then compare it to the slope of this line here. It's in stark contrast to the slope of this line here and the slope of this line here. Like anything else that we look at, this is not a perfect way to assess stock market risk. It is simply one piece of the weight of the evidence. Nasdaq has been relatively weak lately. We could have said the same thing here in 2009. Could have said the same thing here in 2011, 2012. Could have made the same argument here early in 2016. The Nasdaq Tape Index made a stand here, 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 and we're in the same general area in the present day. Stock market made a stand here, here, and here, and we're in the same general area in the present day. Like every single chart that we look at, this doesn't predict anything. It simply helps us assess odds. U.S.-China trade talks are set to resume on October 10th. That appears to be reflected in the chart of semiconductor stocks. It appears that SMH filled this gap here and thus far has held. We also have a lot of white space down here telling us that the institutions, for the most part, they have not given up on semiconductor stocks as of this recording. NYSE Technical Index. This is a chart that we covered in late August. It was dated August 27th. It's the S&P 500 on the bottom of your screen here. You can see the technical indicator made a stand here. The S&P 500 made a stand. Similar concepts here. Similar concepts here earlier in the year. In late August, we said we were concerned because we're at a point where the market needs to make a stand and we need institutions to step in. How does the exact same chart look after all of the news events of the past 4 or 5 sessions? Better, worse, or about the same? The answer is quite a bit better. This version of the same chart is dated September 25th. How about this argument? The stock market's been going sideways for a long period of time. That means we are topping. We are forming a major top. We haven't made any progress, really, when we look in the rearview mirror. You can pause your video player to read the details here, but that really doesn't align with the way markets have worked historically. The quote on the right side of your screen: equities have always had a double-digit rally before the economy experiences a downturn. The average gain prior to the peak and the downturn, 17.6% when you look back 1 year. Do we have anything remotely close to a 17.6% gain if we look back 1 year in the present day? The answer is no. We're up only 2% if we look back 1 year, telling us to keep an open mind about better than expected outcomes looking out 12 months. S&P 1500. This 1500 tells us this is a much broader index than the S&P 500. You can see here the AD percent for this index. Above the Bollinger Band here, above the Bollinger Band here, recently above the Bollinger Band. After this look, good things happened in the stock market. After this breath thrust, good things happened in the stock market. This looks similar to this, and this speaks to the actions of institutions. You can make an argument that the present day look on September 26th really doesn't look anything like this concerning look here before the S&P plunged. Notice here we're above the Bollinger Band, no white space. Look at all of this white space here. This tells us that this trend is waning and more susceptible to rolling over here. How about the Chicago Fed's National Financial Conditions Index? Chicago Fed gave us an updated reading this week. Does it look anything like this average reading that would be concerning, or this median reading that would be concerning? Readings that we could see, measure, and put in a model before really bad things happened in the stock market. These are the type of readings in the National Financial Conditions Index that we want to avoid. Higher is tighter. Lower is better. Last week we covered a reading of negative 0.72. We have a new reading. Is it better, worse, or about the same? We'll let the Chicago Fed answer that question. Financial conditions loosened. They're not tighter, they're more favorable. And the index has 3 sub-indexes: leverage, credit, and risk. All 3 of the sub-indexes are well below 0. A lot of talk and concerns about the short-term, extremely short-term repo market and Fed intervention. We're just not seeing stress in the credit markets using an extremely broad gauge. As we have mentioned in the past, credit stress and things in the credit markets can change quickly. That may happen, but it hasn't happened yet. NASDAQ stocks greater than their 200-day exponential moving average. Another way to monitor what's going on in the minds of institutions and what actions have they already taken. August 28, 2019, we said this is somewhat of a vulnerable look here. We don't want this look to morph into a look like this. How does the exact same chart look this week? The answer is quite a bit better than it did at the end of August. You may say your chart only goes back to 2016, okay? Market held here after a breath thrust. Here's a breath thrust here in 2011. These are pullbacks. The market held here, then the S&P 500 did well. This is a breath thrust here, pullbacks. The market held here. After that, stocks did extremely well. Hard to make the argument that this breath thrust here and these pullbacks are discernibly different than this period here and this period here, where in both cases the NASDAQ did extremely well after holding above the green lines. Similar situation, NYSE. Basically everything that we said about the previous chart applies to this chart. This is somewhat of a concerning, we need to make a stand soon look in late August. If we fast forward to September 26, 2019, we have made a stand near the important region. Value line geometric index as of the close on September 26, 2019. Index is rejected here in 1998. Rejected again in 2007 here. Rejected again in the same basic area between roughly 2014 and 2015. What once acted as resistance may now potentially act as support. You can make an argument that this still looks like a bullish breakout and a retest of this area here, here, and here. We'll learn something either way. This is somewhat of a dicey look here, but right now it appears the breakout is still holding. S&P 500 breath momentum oscillator. Somewhat of a concerning look in late August. Have we morphed into a concerning look like this or a concerning look like this? Here's where we are here in the relatively early stages of this decline in 2018. Have concerns about impeachment caused this chart to morph into something that looks more like this? The answer is no. This chart in the present day, September 26, looks a lot better than this point here, and it looks a lot better than this point here. In fact, you can make an argument that this breath thrust here is similar to this breath thrust here, And this breadth thrust here is similar to the one that we just experienced in 2019. After this point here, good things happened. After this point here, good things happened in the S&P 500 on the bottom of your screen. And with this look here and this look here, which is similar to this point here and this point here, really good things happened in the stock market for a long period of time. Doesn't predict anything, just helps us assess odds. When we look at this chart here on September 26th and ask ourselves what it tells us about what's going on in the minds of institutional investors, and more importantly, what actions have they taken this week, or what actions have they not taken this week? Does the look of this chart here align with this basic theory here relative to the probability of the president being removed via impeachment? You can make your own assessment. You can pause your video player if you would like to read these tweets in more detail. The basic gist of it, July 26th. Rates have been low for a long time. Eventually, that may show up in future economic data, and that's exactly what happened this week. September 25th, the housing market, the most sensitive sector to interest rates, has perked up in recent months in response to a sharp drop in mortgage rates. From a news story this week, new home sales rebounded 7.1% in August, flirting again with a 12-year high. You can see on this chart here, home sales typically peak before a recession, shaded area. They peak before a recession, they peak before this shaded area, peak before this shaded area, peak well before this shaded area. This is the highest high here before the recession, highest high well before the recession. We are knocking on the door of a new high in this cycle. We're not there yet, but you can make an argument that the rebound that we're experiencing in the present day has a high correlation to interest rates. And during Thursday's session, the market was pricing in 70% odds that the Fed would cut rates again before the end of the year, providing a tailwind on this chart, telling us to keep an open mind about a new high. That, of course, is to be determined. It has not happened yet. And you may say the economic data has been pretty good. Why would the Fed cut rates again? Because the Fed has been way behind the market, and the Fed is still off. Yields on 2-year treasuries, 3-year treasuries, 5-year treasuries, 7-year treasuries, and 10-year treasuries are still lower than the federal funds rate, telling us to keep an open mind about another Fed rate cut, even if the economic data continues to improve. All of that is to be determined, and like everything else, we'll take it day by day. Home sales this week, better than expected, which aligns with the sentiment trader data that we covered on September 13th, which basically said when the S&P 500 World Citigroup Economic Surprise Index rises above -7 for the first time in at least 50 days, which is what happened during this week here. The average gain for the stock market looking out 1 year, 14%. How many times was it positive? 100% of the time in these historical cases. We also noted with this realistic expectations bullet, wasn't necessarily fun and games every single day and every week. Volatility is a normal part of all trends, even bullish trends. Did we see anything on Friday that aligns with the better than expected economic data theory? Yes, on Friday, U.S. durable goods came in above expectations. Another breadth indicator, Nysc, new highs. Similar concept, so we'll move quickly. This is the look down here that we would like to avoid. This is a more vulnerable look for the market. This is the S&P 500 on the bottom of your screen. If we fast forward to the present day, Have we morphed into this type of concerning look? The answer is no. In fact, the bias for the month of September, or at least for the past couple of weeks, has been for this to move higher. And remember, this is the type of look that we want to avoid. In here, we really don't have anything in the entire calendar year that's been down in that area. And once again, that speaks to the behavior of large institutional investors. You may be thinking you're biased. You're only showing new highs. You have to add in the new lows. Okay, that's fair. Exact same concepts here, but now we're looking at new highs minus new lows. This is the type of look that we want to avoid. Bad things, bad things. We held recently here when the S&P 500 made a low in late May, early June, made a stand here. How does the exact same chart look after the impeachment announcement, after the transcript was released, after the whistleblower report was released, and after Thursday's hearings? Better, worse, or about the same? The answer is better relative to this look here, and this look here. Nothing particularly magical about any of these charts. They simply help us assess probabilities. Nysc Composite Stock Index. September 26th, market needs to consolidate its gains. Consolidates, rallies. Market needs to consolidate its gains. Consolidates, rallies. Market needs to consolidate its gains. Thus far, we're holding above these key levels here. Remember earlier we looked at the NYSE common stock only advanced decline line. You may be saying nobody uses the common stock only version. Okay, then we'll use the standard version. NYSE advanced decline line monthly. Exact same concepts. The breadth indicator peaks roughly 2 years before the S&P 500 peaks in March of 2000. In this case, indicator here, breadth peaks 4 months before the S&P 500 peaks in October of 2007. This speaks to institutions running for the exits, institutions finding an exit, making their way toward the exit. How does the exact same chart look today? Do we have a bearish divergence in place, as we did here? Do we have a bearish divergence in place, as we did in October of 2007? No, we have a bullish divergence in place. The slope of this line relative to the slope of this line. This has already been printing new highs. This has not yet printed a new high. How about high yield bonds? Common sense and self-preservation tell us the chase for yield ends when concerns about the economy and concerns about increasing bond defaults start to rise. Nobody wants to invest in a bond that they believe is going to default. 10-year yields plunging here in 2007, 2008. Was that causing investors to chase yield in the high yield arena? No. It's a high yield bond fund here. It's making a series of lower highs. How does the exact same chart and the exact same fund look today? Better, worse, or about the same? The answer is quite a bit better. And once again, you can make an argument we have a bullish divergence. The S&P 500, for the most part, since this point here, has been moving sideways. S&P 500 on the bottom of your screen. The high yield bond fund that we just looked at, the same fund, same ticker symbol, has left this high in the dust and has been making a series of higher highs and higher lows. In fact, it hit a new all-time high this week. Hard to make an argument that market participants believe that default probabilities and economic expectations are both about to go in the trash can. Like any other chart, this is subject to change, but the important thing is it hasn't changed yet. Is there any other reason to believe that the stock market could push higher in an unexpected manner? The answer is yes. 3.4 trillion reasons in the form of cash on the sidelines. Is everything perfect? Unicorns and rainbows? Absolutely, positively, no. During Friday's session, some news came out related to the United States and China, and the market dropped a little bit, telling us that the stock market and institutional investors probably do not have much more patience relative to the trade negotiations. Is there anything on this chart telling us to keep an open mind about worse than expected outcomes? Yes, we'll learn something either way here. You can also make an argument that price hovering around the 50-month moving average does not look that discernibly different from this point in the year 2000 and doesn't look that much discernibly different relative to this point in 2007, early 2008. Here's an example of why we always say we'll learn something either way. We'll learn something bullish if we move in this direction, and if we morph into a look like this or this, then we'll learn something about bearish probabilities. At CCM, we've been studying stock charts for a long, long time. If you ask me, is this a chart that I'd really be that interested in from a long-term perspective? My answer would be no, and I hope that's for obvious reasons from a trend perspective. What are we looking at? This is value stocks relative to growth stocks, and the moral of the story is this chart has a lot of work to do. It may be successful, but it really has not proven much yet. How concerned should we be that previous market leaders or momentum stocks have been struggling recently? History says not all that concerned. You can pause your video player and read this blurb on the right side of your screen. Remember in August, we said that the bond market may have gotten a little bit ahead of itself. In the previous two times that we had a look like this, really the only two times dating back to 1960, the stock market after those 2 points significantly outperformed the bond market. And here's the look of the chart on September 12th, where we also said it was similar to this point here. This is 10-year yields, and this point here. Notice the move off of this low was not really all that clean. A lot of indecisiveness in here. A lot of indecisiveness in here. If we fast forward to the present day, really don't have anything over here that looks discernibly different than this area here, nor this area here. Here's another question that may have popped into your mind relative to this topic. Wouldn't it be logical to assume that these approval ratings are going to plummet after all of the news that came out relative to impeachment this week? Given this headline here, dated September 27th, you can also make an argument that these numbers will most likely remain stable and they could even improve. How about credit spreads? Have we seen anything that's alarming? The basic answer is not yet. Credit spreads in the present day down here. You can make an argument that stress in the credit markets or fear in the credit markets about bad things happening is significantly lower than it was in late 2018, early 2019. These charts can move relatively quickly, but these are the facts that we have in front of us today. S&P 500, August 29th, 2019. We covered this exact chart in a late August video. This is our indecisive look here. Does this chart look better, worse, or about the same? On Friday, September 27th, 2019, the answer is quite a bit better. Moving average cluster gets a tight look here after moving sideways and really bad things happen in the stock market. We've got a very, very tight look here. The difference is slopes are all down, price is below. Slopes are all up, price is above. Also noteworthy, during Friday's session, 9:49 a.m., we are above the highs here in September, October of 2018, and we are above this high here in May of this year. It's hard to make an argument that price is overly concerned about the news items that have come across the wire over the past 5 days. Like any other chart, this is subject to change, but this really doesn't look that bad right now. We're well above an upward sloping 200-day moving average. During this entire episode here, since this high, price has never touched the 200-day moving average. It's quite a bit different than this period here, and this look here relative to the red 200-day moving average. This white space is radically different than what we saw here prior to this plunge. This look here, relative to this look here, also speaks to what's going on in the minds of institutional investors and what actions they've taken to date and what actions they have chosen not to take to date. During Friday's session, we could also say that the market came back for a second time and tested this gap and thus far has held. Last week, we noted that China remains a wild card. If you have a lot of experience reading the tape, I think you would agree that China is still a wild card. The market remains very, very concerned about trade negotiations, probably does not have much more tolerance for unfavorable outcomes. It may also be worth a visit to the new website to see the FAQs. We've got new and expanded FAQs covering traditional investing, low-cost passive investing, and the online/robo strategies that are currently in vogue. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.